Okay, at this time, I call the risk management and insurance meeting to order. And I'd just like to give a little preface. I mean, we have these meetings to look at different plans and stuff like that. When we do meet, it's not to exclude anyone. It's just to look at different options. And I was just telling someone in the audience, I mean, it's not just what we face, it's what everybody's facing in the insurance industry. So just a little preface. I mean, now I'll turn it over to our insurance people, Samantha and.
Thank you, Mr. Oakwind. Good morning. My name is Samantha Burris. I'm the insurance technician for St. Charles Parish Public Schools. Today, we will receive presentations and information regarding the Medicare Advantage plan design options, proposed revisions to Board Policy 4.6.13 retirements, and changing the health plan renewal date. Joining me is Ms. Darenisha Gray, General Counsel and Director of Risk Management and Benefits. And from USI, we have Mr. David Babin, Employee Benefits Producer, and Mr. Jesse Babin, Senior Vice President. First on the agenda is to discuss the Medicare Advantage plan design options. Before I turn it over to Mr. Babin, just a few important items. As a reminder, the board approved the renewal of the Humana Medicare Advantage plan with the decoupling non-integrated option with Humana at the July board meeting. And today, the purpose of today's presentation is to present options for plan changes. A total of 9 options will be presented. We will also discuss the member impacts of the proposed plan changes. And the goal is to ensure that the board has the necessary information for consideration of a plan design change. Another important note is that Humana's deadline for plan design changes is September 1st. So therefore, the board must consider and approve any proposed Medicare Advantage plan design changes at the August board meeting. So with that, I will now turn it over to Mr. David Babin.
I'm sorry, Ms. Pierce, can I just say one thing as well? And because this does have to be put on, it currently is on this next upcoming board meeting. We've not publicized that meeting. We'll wait until the outcome of this meeting because there are some recommendations that this committee will make to the entire board. So just so you know, there are 2 agenda items that are waiting for the outcome of this particular meeting. Thank you. Sorry.
Thank you, Dr. Ortling. Mr. Babin, you may present.
Thank you, Ms. Pierce. Thank you, everyone. So we're here to talk about the different options that we have to reduce our renewal for our Medicare Advantage plan. Just as a recap from our last meeting, Humana had initially come out with an almost 40% rate increase. And with Humana's redesign of the way they administer their program kind of behind the scenes and their further integration with CMS, they offered what's called a non-integrated plan, which reduced our 40% rate increase down to a 13.31%. So from there, that was approved last meeting, and here we're talking about different plan design changes to further reduce that 13.31%, whether or not that makes sense for us and whether we want to move forward with any of those. As a reminder, that again, last meeting we showed different options to include. We separated the medical, so we looked at medical options, just affecting the medical benefits. Then we showed just pharmacy options, and we also added in 3 more options to include both medical and pharmacy, combining them, which we can see deeper discounts. And again, kind of a recap over the last 15 years that we've had Humana Medicare Advantage, we've always offered a very rich plan, the richest plan that Humana has offered. It's essentially zero out-of-pocket for our retirees. When we look at rising claims costs, rising specialty medication, when Humana came, that was one of the cost drivers of the block of business. Because we're fully insured, we're not able to drill down on very specifics on our own claims data, but we are, and we're able to see that specialty medication was some of our primary cost drivers. And when you're fully insured, really the only way to reduce the benefit is to make a benefit change. So, you know, what will have the most impact most likely would be something around pharmacy, but we will look at all the options available to us. Page 1 are the medical options. Again, these were presented in our last meeting. but these are adjustments that would be made only on the medical benefits. This would not affect our pharmacy plan. The only change that's mandatory on the pharmacy is the out-of-pocket maximum, which is going from $2,100 to $2,400. That is a CMS required change there. But outside of that, you have a $50 deductible that would be added. The out-of-pocket also would be mandatory on any of these changes of $500. We had some questions and answers in the back of the presentation, just kind of put some foundation around the changes and the impacts on our retirees. In traditional insurance, deductible traditionally only applies to deductible and co-insurance benefits, inpatient, outpatient, specialty imaging. Well, on Medicare Advantage plans, if we add in the $50 deductible, it applies for whatever service you utilize first. So if I go see my primary care physician, it's going to be a $50 deductible. Once I meet that deductible, I don't pay anything else the rest of the year. So even though we're putting in a $500 maximum out of pocket, my out of pocket would literally be $50 for the year. So, and then that would go down the line if we add in, as an example, on option B, we add in a $5 doctor office visit, $5 urgent care specialist. I would pay my $50 deductible the first time I go in, plus my $5. I'd pay $55. And then from there, if I utilize a copay again, it would only be a copay, utilize a copay service. So once I satisfy the 50, it's satisfied from there. So I'll take a moment and we can reflect on these options here if there are any questions.
I didn't want to interrupt you, but when you mentioned in the beginning about a zero out of pocket, just for clarity for those in the audience and anybody else might be watching, you're referring to what's out of pocket in the actual plan, like so some people may have to pay a few dollars. You're talking about what's in the plan when they go to the doctor.
Correct.
Right. Okay.
Correct. Yeah, I mean, we have the
So everybody
pharmacy.
that thinks that it's completely free, they might not. Some of them, depending on the next agenda item, will cover those things.
Right.
No, I just
exactly,
want to
yeah, I
make,
see what
just
you're
in
saying.
case somebody that you and I both know.
Not referring to premium or any contribution cost.
Right.
This is more or less benefit utilization. We have prescription copays that are in place, so you do have a copay for prescriptions. But as far as when we go and utilize services right now, it's zero out of pocket when we go to the doctor.
Perfect, thank you.
If I may at this time, just remind everyone, this is for the Medicare Advantage. Remember, a few years ago, we made everyone who was eligible for Medicare to get onto this plan, okay, which was a cost savings to the district. There are some members, some retirees who are over 65 who never paid into Medicare because they were in the teacher retirement system. They are on our general plan and remain on our general plan and never will be on this plan, okay? So I just want to remind people, you have to have paid into it, whether it was through a spouse or through payroll deduction, or you could buy into it. I know employees who have retired who have paid in, bought into it so that they'd be eligible for the Medicare. And also, just one other thing, the Medicare portion, and correct me here, Plan Part B, the person is charged by the federal government monthly for that service. So it's roughly about $200 a month now, given how much money you've earned through your career and so forth. But teachers would fall under the low tier. But I just want to bring that up, so.
Yes, sir, that's correct. The standard rate for the Part B premium is $202.90 per month, and each member is required to pay their own Medicare Part B premium. Yes, sir. So just to recap what Mr. Babin just presented on page 1, there are the 3 options. These are changes to the medical side only. So option A is the least amount of changes to the medical side, and option C is the most amount of changes to the medical side. If you look at the bottom, you can see the financial impacts for each of the 3 options presented. Are there any questions relative to options A, B, or C before moving on to D, E, and F?
Just for a point of clarity, Ms. Pierce or Mr. Babin, younger Mr. Babin, is generally speaking, there are 2 things that we want to consider, the medical options and then the pharmacy options. So it may while I recognize the next thing is to go over pharmacy, I would recommend that we at least talk something about A, B, or C, because the board's gonna have to consider a recommendation relative to this. So, like, as far as, when I looked at this and I met with Ms. Gray yesterday, considering previous board feedback relative to modification, slow modification, and this board has traditionally not tried to disrupt, especially when it comes to our retirees, while at the same time recognize exactly what Mr. Babin referenced relative to all the changes and the increase in costs relative to medical health care plans. Option B is, to me, is a small increase. It doesn't impact our retirees significantly. They still have the out-of-pocket of $50. It does get them used to having a small copay. So it is kind of a balance between the two, but I know traditionally the board has steered away from changing those kind of things, but it's a minimum cost of $5 copay. You're still, the deductible is $50, which you receive in option A as well. But when you look at the actual impact of that on the Medicare retiree, it's not significant from what they're currently paying, but it makes for the annual total. Correct. So it seems to me, and I haven't run this through some whatever y'all term, using, a correlation between the benefits and the actual impact on cost, but it seems from a very broad view that option B is a good bang for your buck relative to savings.
And I agree with you, Dr. Orling, especially when you keep the plan intact as far as its richness. I mean, the benefits don't go away, and our employees do appreciate that. But I think every entity out there, their insurance is a game changer, and it changes every year. So I know lots of folks, that they get their renewal and they get costs passed on to them. So I think I could live with plan option B as a change.
So, and not that I'm saying I'm going with this, I'm just talking. So when you look at option C, the reason why we're thinking maybe option B is going to be an easy transition going from what they pay currently right now to a minimum cost. But if you look at C as well, when you think about what other employees pay, their co-pays are a lot higher. So I know we're looking at richness. I know we want to take care of them. So I'm just wondering the thoughts of everyone else about the C. Not saying I'm going with C. I'm just want to know the conversation of what makes you think we shouldn't go with C.
My biggest thing is just being too disruptive.
Okay.
The least disruptions as possible, okay. and that's just my point.
Okay.
I'll just say that B and C are of interest. I think that, and this is paint with a broad brush, but I think that we've got to make some move. To your point, and to everything you just said, because to avoid the drastic, to Mr. Oko's point, you got to make some little move, because if not, to me, I think the writing's on the wall for next year if you don't, or the following. So I'm of agreement with having to do something.
So I just want to make sure that I'm clear on this. Page 1, just medical. Page 2, just pharmacy. Page 3, both of those added together in the same box. So the reason for separating both conversations is just a breakdown to be able to see the differences on a smaller scale, but the decision we have to make is the bigger scale for both, right?
You can either only make changes to only make changes to medical, only make changes to pharmacy,
or
say you're gonna
both. So
change
it's not
both.
even like a small working into it for us. Oh,
Yes, ma'am. So
okay.
so the board can decide, we're only going to make changes to medical, we're not going to make changes to pharmacy, or you can only make it to pharmacy and not medical, or you can say, let's make changes to both. And the reason why they're separated is because last month, the board voted to do the decoupling option.
yeah.
Yes, ma'am.
I was going to ask a question, but then the pharmacy part's next. Can we go to the pharmacy part? Because I guess my question was going to be, I noticed just for example, you have 3 options on each. So if I look at option B and C, we're looking at I'm ballparking here, doing Common Core math in my head. 120,000, let's say for option B, savings approximately, whereas, I look at the second option on pharmacy only, now you're looking at 34,000. So it seems like the medical saves us, the adjustment on the medical would save us more than the adjustment on the prescription. And I don't want to
But
jump
the-
ahead of you, so.
Yeah.
Pharmacy that's costing the most. So we're going to make the adjustment with the first one, but the pharmacy is the one that's costing us the most, so then we would have to come back and make a whole
I
different
think if he goes
decision.
through it, that's why I was kind of, and then
Yeah,
ask that question. I don't want to jump ahead of anybody.
I like jumping ahead.
If I could just respond to Ms. Weber's, just when I think about our retirees and some of what Mr. Art meant, or Ms. O'Quinn had mentioned relative to the disruption, I specifically look at emergency room, inpatient, outpatient services. So currently, right now, they don't pay, especially when it comes to emergency room. Now, while emergency room certainly for us, it's a significant cost on the back end, to me, that's different. And you, obviously, the older you get, typically, you probably go a little bit more. So that wouldn't be as much of a disruption from that standpoint if you land somewhere on B instead of C. So that's kind of where I would see
And
the
if you look
disruption.
at that, I mean, you go to the emergency room, you pay the $50 deductible, then you met your deductible, you're done. So you're back to zero again. So it's all minor changes. Is what's the board's pleasure as far as, what we feel needs to be pushed on, to our retirees.
For clarity, what is inpatient, outpatient services?
So outpatient typically is, a service, if you had a surgery and you were in there for one day, if you're admitted after typically 24 hours, it's an inpatient.
Not overnight. Like something like-
Inpatient would be overnight
It would be overnight, yeah. If you had-
Inpatient's overnight,
yeah, Inpatient,
outpatient's not.
correct.
procedure that you're like having
Yeah.
surgery, but you can still go
Like if you have
home
your
that day.
tonsils, your kid has your tonsils removed, they're in and out.
it's-
Knee surgery where you're in and out the same day as opposed to inpatient.
Clearly, Ms. Gregson handles that in my household.
Can I ask, how I like to ask questions that are going to take me all the way back around to the point of it. We've had lots of conversations about insurance and different goals. If our goal is to drive people to the doctor, then we make this decision. If our goal is to save money, then we make this decision. If our goal is to protect our retirees to where they feel safe and comfortable to handle their medical needs as they feel fit, that's a different conversation than if our goal is, we know that inpatient, outpatient, emergency room is costing us significantly. Putting a small dollar on that removes I'm going to go to the emergency room because I have an ingrown toenail. You know what I'm saying? Like if we have to have those conversations about what our goal is here, because it's not just about saving money. We want our retirees to feel like they are cared for. But if we can accomplish that same goal by saying, well, it will at least cost $5, then I'm at least going to take a second and think about my next move, not get care, but is there a better way to get care? So for that reason, I'm leaning more towards option C. Not to cost people more money, not to make it harder for retirees to get care, absolutely not, but to say we have to put some safeguards in for the district to say we want you to have everything you need, but we also have to protect ourselves moving forward that this doesn't get much bigger than it is. Or we won't be able to help nearly as well as we are now.
Yes, and I think the goal is always to provide, comprehensive benefit package to our retirees while, keeping in mind the budget considerations for the district as well. I think putting this in place would still provide a wonderful benefit to our retirees on Medicare Advantage. When you compare, Mr. Babin, you want to chime in as well, when you compare other Medicare Advantage, this is the Cadillac plan of Medicare Advantage plans. So even with a minor change or minor tweak, it's still a very rich plan that we would offer to our retirees on Medicare Advantage.
And I agree with you, Ms. Burris. When we switched and made all our employees get on this, a lot of people feedback was, my cousin Joe's Humana plan, it's not good. But they didn't understand that the plan that we were going to present to them was the Cadillac plan. And I think if you go speak to anyone out there that's on this plan now, they're extremely happy, so.
And Mr. Babin, before you respond, also, can you kind of, for the general public and board and me as well, relative to the difference between our regular employee plan on what the district pays relative to claims, and then from a Medicare Advantage plan, how the government's involvement, right, with that plan is different, so that we have a true context from a cost perspective, to Ms. Boudreaux's point. It is different on how those claims are paid and we're reimbursed, so on and so forth. So can you kind of provide that overall overview? Because it really is, it's different, right, and it has a different impact.
Absolutely. Yeah, in the way the group Medicare Advantage work currently is sort of how we operated before we moved self-funded. We were fully insured prior to being self-funded. We paid a set premium each month, and the claims experience really boiled down to claims versus premium, and that is what determined our renewals. Once we moved self-funded, now we're responsible for our claims, first dollar up to, our protections, our stop loss. And so, our impacts on plan design really affects the financial aspect, because we're paying for all of our members' claims. Fully insured benefit like group Medicare Advantage, the only way to really move the needle is to make a benefit change. So we're not responsible for claims, shock claims that happen, cancers, critical illnesses. I mean, that's all paid out of the Humana Claims Fund after they collect premiums and then their coordination with CMS. So the only way to really control the premium is to make a plan adjustment. And I'll say that, carriers like Humana look at plan designs like ours that are extremely generous and rich, is the way they typically define. And when they're renewing their block of business, they tend to hit those that have a richer plan with a little bit higher renewal, because they know they're paying a lot more for that program. Making an adjustment to a pharmacy benefit of adding in a $100 deductible, if you have a specialty medication that costs $30,000 a month, it's not having a significant impact on that, but it's the more of the smaller utilization where they know that they have a little bit more responsibility from the members that helps drive those claims down and help drive our renewals down. So I think, from our perspective, claims continuing to go up, and our plan has stayed very level as far as the richness. And at renewal, we're going to continue to see those renewals coming up. So kind of the points that are being made to help kind of head off those renewals and more catastrophic renewals, plan design changes are recommended.
And if I may add something too, 37, 38 years ago, Mr. Babbitt might be able to help me here. That is when our teachers, our employees started paying into Medicare. There were some folks, and I'm gonna just use Ms. Weber as an example, they never paid into Medicare. So they were on the district plan forever, okay? But anybody who's probably gonna retire now, if you think 37, 38, they've been paying into Medicare, so they're gonna be eligible for the Medicare Advantage. So most of our employees in the future, and this is why we did this, are gonna fall under the Medicare Advantage plan. The retirees aren't gonna be on our general plan. And I hope that makes sense so that you can kind of help you make a decision.
And that's a cost savings to us because the federal government pays the bulk, pays the claims, and we just pay this.
For a lot lower premium.
Yeah.
Right.
Yeah, again,
That
you still
context
pay
is
that
very important.
$202 a month premium, you have to pay it, but you've paid into it for 30 years, so that's the benefit that you're gonna receive from the fact. Even though you may not draw the Social Security aspect, you're on the Medicare aspect with the federal government.
See, that's a very different conversation because when we talk about our general plan, we're still on the other end paying for all of it. Now, you go to the emergency room, we're paying the whole bill. You might be paying $50 or $55, but we are paying all the dollars. Whereas this is, if it's $50 or if it's $5, we don't pay any of the other side. We just pay the part at the beginning.
Premium.
Well, now I don't know how I feel about this at all.
And yes,
Give me a
ma'am, and that's
second.
why they pay, when they
Thank
pay
you for that clarification.
the $200, that's what they're paying to the federal government to supplement the other half of the claims.
Okay.
And so
Part
for
B.
us,
Okay.
offering this Cadillac plan, even if you compare it to Office of Group Benefits, which I briefly had showed Mr. Gregson, let me show you what Office of Group Benefits they are still paying a bigger premium to them, and they don't get these same benefits. So us putting a $5 copay is minor compared to the
Okay.
plans that OGB has, and they don't even offer all of the same benefits of care, of doctors that they can see, procedures that's covered. Our plan is much more
So we-
widespread.
We looked at that yesterday, and it kind of blew me away, I guess, to say that they're paying much larger than what we're even looking at. I mean, look, and not to jump ahead, but if you go to option I, they're paying more than that, a lot more than that. And by the way, don't even have the benefits that we have on this plan. And I think some retirees have mentioned that they go to the doctor, tell them, oh, this is going to be, they're talking with their provider, this is going to be covered, it's going to be $0, and the provider's like, no, I don't think so. Until they go verify it, and they're like,
And then it is.
wow. So,
All right,
There we-
continue with your presentation. I'm so sorry, but thank you. That changes the way I hear this.
That's great. And kind of to Mr. Oquan's point, a lot of bad rap in Medicare Advantage plans comes from the individual market. The reimbursement from CMS is not good, and a lot of doctors don't take the individual Medicare market, so it tends to get a bad rap. But the group Medicare market is highly coveted by most all providers, and it's a great benefit. So, and then, on page 2, just to kind of wrap up, we briefly discussed, but that is making only changes to the pharmacy. Very slight change on option D to the copays. E adds a $100 drug deductible, and F adds a $200 drug deductible, and that's a one-time deductible, calendar year deductible. And then on page 3, it combines both of them, as we've mentioned. So the medical changes are identical to page 1, and the pharmacy changes are identical to page 2, just combined. Yeah, absolutely. Yeah.
And Mr. Babin, can you speak to the member impact with regards to adding a deductible to the pharmacy side?
Sure. So first dollar, first time I go get a prescription filled in the calendar year, if it's an Ozempic and it costs $1,200, I'm going to meet that $100 deductible on my first prescription that I fill. If it's a generic and it costs $10, I'm going to pay $10 until I meet that $100. So once I meet that 100, then it's satisfied for the calendar year. Then I get into my copays, and it maxes out at the $2,400.
Meet the 100. Like you could just pay $40 for the year because, okay, so it's not a requirement to meet the 100.
Correct.
You won't be going to the pharmacy and it's $10, but your deductible is $100. You're not gonna pay that $100. You will, make sure I'm hearing this right, you'll just pay that $10 until you meet that $100, correct?
Correct. But you'll pay the full cost of the drug, right?
Right.
And the tiers are set up. Tier 1 is typically maxing out at $10. That's typically your generics. Then you get into brand name and specialty. Whatever the cost of that medication is, you'll pay until you meet your deductible.
I just want to make sure we're very clear because there's always a lot of chatter among our retirees and our current employees. Like, I got a few calls about that, and I had to call Ms. Barris. I'm paying this much. I had to pay this huge deductible, but my friend who's retired didn't have to do that. So we had to explain that whole situation, and we had to explain about the deductible. So I just want to make sure we're clear on the two separate ones, and that people are not confused. If you're a retiree and you're on this plan, this is how the plan's gonna work for you. So I just wanna make sure we continuously say that, because when people are talking, I don't think they realize that person's not gonna say, oh, I'm retired, my plan might be different. They don't realize that the plan is different from this one. So I just want to make sure we continuously have that conversation.
And you got to remember, as a teacher, you could retire after 20 years, so you could be 42 years old, and so you can't get onto this plan for 23 years.
Yeah.
That's something that, people, So, I mean, there's one thing that's called retiring from teaching, but to be eligible for the Medicare Advantage, you have to meet that 65 years of age minimum requirement.
Okay, me again. Sorry. You said we did the decoupling so that we didn't have to necessarily group it. Is it an option to do option B for the medical and then option D for the pharmacy? I know that's not in a pretty package, but is
We can
that
do that
possible?
combination.
I'm not saying that
It's
we
kind
need,
of, we have unlimited, we can
Ways
mix
to
and
do
match
it.
how we want to do it.
But thank you for not putting them all on
It-
there.
One thing I'd say is not additive, right? So when we presented the options, they all had a dollar amount affixated to the changes. And so if you took all of them together, it added up to like $18 off the premiums. But it's not additive. It goes to underwriting and it might be $16 and change. So if we want to make an adjustment, we can. We'd have to go to underwriting at Humana and just have them verify that.
because here's
If it's
my,
outside of what's presented.
my thought process behind it in wanting option B specifically for the medical, but wanting something a little different for pharmacy, is the 70-year-old who only needs the $5 pills every month, but now she's going to have to keep paying it till 100 versus the person who's going to spend, $80,000. They're going to pop that 100 out first time and then never have to pay again. It's not a huge difference, 285 to 304, to protect all the people that wouldn't affect. Does that make sense?
So in other words, option H, but with the drug copays that are on option G? Is that what you're saying?
Yeah, the prescription part of option G, but the rest to be H.
Yeah, so combining option B and D, correct? Is that correct, Ms. Boudreau?
Yes.
Would that be
Yes.
B and D?
B and,
You do
B and
H?
D.
Combining option B and D.
No, I can't go with the flow. Have you met me?
And
There's
just
whatever the
thinking,
flow is, it's,
A time, and
And again,
relative to timing.
Again, like I said, I just think we need to try to make minimal changes, because as soon as we
think
get out of
that's
this
the most
meeting,
minimal we
we're
can
going,
make.
it's going to leak, and these retirees are going to start calling me, y'all messing with our plan again, okay? It's going to happen. So.
It's still a change
again,
without the most
We got to ensure
disruption.
to let our people know that that the policy is going to stay rich, but there's going to be some minimal changes. And that's my goal with this whole meeting.
May I interject with just a quick comment, board attorney hat on real quick. We have to post 24 hours before our agenda items, and so the posting was gonna happen today. So if we have to go back to Humana for underwriting, we may not have the information in time for posting.
oh, so H is already written.
So these have already been verified, but if we want to combine options, what Mr. Babin was saying is we have to go back to Humana because this is a fully insured policy and not self-insured. So we can't just
So we can't pick B and D.
we would have to go to Humana to get them to verify it. I'm just not sure how long it's going to take if we'll get it back in time for the posting
Okay.
to the public.
So no, I guess to that point, because the meeting is on Wednesday, I don't know how long it actually takes to do the underwriting. Is that because it's flexible to Wednesday or no?
It's been taking about 48 hours to get it back.
Monday.
So we can put in request it immediately following this meeting, and we could ask for it to be expedited.
Yeah, because Monday's meeting is just for the board to make a recommendation to the full board.
Right.
To be on the table for Wednesday. So you have enough time before Wednesday is actually the decision is going to be made then, officially. So would that give you enough time to underwrite it to at least provide that information?
Tuesday evening.
Yeah, it
I
would
mean,
have
does
to be a
anyone else
Tuesday about
actually
6
want
o'clock.
that before we change it?
Ms. Boudreau, what is your recommendation? And then we can go ahead and kind of approve it as a
Recommendation
committee
would be
and move
B
it
and
forward to.
D.
Okay.
But
So-
just because it was like a little bit of change, but not a significant change, what was still moving the needle, but H by itself was a pretty significant jump for, paying nothing to now having to pay a $100 deductible. Seemed bigger, but I don't necessarily love G by itself.
Before if we can, pause just for a second. I'm gonna go back to my question before about, I was kind of jumping ahead, with the medical and the pharmacy. Do we know, and of course, we have more data, obviously, on our active plan versus what we possibly have here, I don't know. It seems to me that these prescriptions would possibly impact, and again, if I'm wrong, just correct me here, that the prescriptions would impact older folks. We're talking Medicare Advantage is 65 and over. right, would impact more than the doctor visits. Is that accurate as far as making that?
So if you combine both the doctor visit changes and the pharmacy changes?
Well, I'm looking at this, I'm looking like this. So if I say B or C, right? So C, we're saving, we're not saving, we have about.
Right. Well,
Let's say
avoiding
under
pain.
50, yeah,
Right.
yeah, like, so, let's say, we're looking at right now, if you look at page 1 and to the column to the left of option A, it's 13.3% increase, but if you.
154,000 more.
Yeah, so if you
Right.
just slide over to C, it's just shy of half
Right.
increase. But yet I go over to prescription and I'm saying, well, I go from a 13.3% to only 10.7. I'm really not saving much.
Not a whole lot of savings.
Right, so like, from a budget standpoint, we're really not getting a whole lot of bang for our buck on that. So really, it's more on the medical side, but I feel like, I mean, I know when you're older, you are going to the doctor, I get that. But it seems to me, I mean, I think about my parents and grandparents, like, they more prescriptions and.
Right, right. You think it would be more heavily weighted on the pharmacy
I feel like
than the
they would,
medical?
I feel like it would impact
Yeah.
them. What I'm trying
Right.
to say is the overall cost would be more, I'm looking at the retiree 65 and over is what to what you're saying. And I'm saying, well, the prescription would impact them out of pocket cost-wise more than the doctor because when you start looking at the 33%, I mean, I know those are tier 4 drugs, but I mean, if I'm making sense here.
You are.
Because I just don't see the
have-
savings here. I don't.
The impact for the
Yeah.
medical changes far exceeds the impact on the prescription. However, the impact on the retiree from a pharmacy perspective more impacts it. That's the correlation you're making. I would agree.
Percentage that meet that deductible because of the utilization of prescriptions with our retiree ages. Than a $5 copay at the doctor's office or
That's-
$50.
So that was my assumption. That's what I wanted to ask you. Okay.
Yeah.
So to me, you don't, I mean, even going to option F, right? Like, I'm only looking at pharmacy. That's a drastic jump for prescriptions, but it's less than 3%.
Yeah.
So,
But if you look at G,
Agree with me. is what you're
That's per member, just to
I don't know, I don't
clarify.
know, I
That
don't
deductible, if you have a spouse, that applies to the spouse and the retiree. So it's per member. Just to
yeah.
clarify.
but if you look at G, I think you kind of like, which, if I'm under the assumption that you're putting a medical with a pharmaceutical type thing with G, right? And your savings right there is a 9.42 increase, not a savings, but an increase. So if you look at, and am I understanding this correctly? Because if I look at D or E, and I look at B, I still think you're kind of falling right in the middle of that increase with option G of 9.42% increase. Instead of, because how would you do that? So they're gonna have that increase in pharmacy if you do it separately and the increase in the medical? But if we do a combination, you get more of less of an increase? Am I looking at that
Right.
correctly?
When you combine them.
Okay.
Mr. Jesse?
I'd just like to make a comment along those lines. Statistically, most people will go to the doctor a few times a year, but most retirees are going to use the prescriptions every month. And if you look at the changes to the copays in some of the plans we're looking at, the copays are higher across all tiers. So that would probably impact them financially more than. Talking about the prescription copay? Yeah, if you look at like G, like.
G's the only change for the copays. When you add the deductibles, the copays stay the same.
So if you look at, just as an example, and I'm just showing this as, if you look at H, just as an example, H incorporates the changes y'all are talking about in the medical, and it adds the $100 deductible on the prescription, but the co-pays after that deductible are the same as they are now. So the impact, the long-term impact through the year would be less. as an example, on that plan, because we're keeping the co-pays the same. I'm not suggesting we do that. I'm just want to make sure we understand when we're looking at the changes.
So once they make their deductible of $50 with the medical portion, then they make the deductible of $100 with the pharmacy, it reverts back to the way the plan was before.
Right.
So you're
Except for the
talking about,
$5 co-pays at the
yeah,
doctor's office.
yeah.
I'm of the opinion, looking at this, and the lens, well, one quick question, I just look at my sheet here. The Part B, that's the one they pay to the federal government, is that right? Does that ever increase, or is that like a,
Every year.
Yes, Social Security determines those rates, and they do increase each year. I see it increase anywhere from $10 to $20 each year, per month.
interesting. So with that said, because I had a feeling it did go up a little bit, I'm of the, kind of along the lines of Ms. Boudreau, option, I'm looking at through a lens of budget for the district, and the least amount of it, I'll say the least amount, not a major impact on retirees. I think from a medical option C and from a prescription option D. And that way, to me, I think from a cash flow standpoint, for somebody who's on a fixed income or, the retiree, I think you're not saving that much, even if you look all the way at F for us. You know what I mean? If you just look prescription only, you look at F, I don't think we're saving that much. I'm looking at from the budget side, we don't save, it's not an impact for us, I don't believe, looking at this. But option C, you save money, and it's $5 out. And look, when people are going from an active plan and they reach 65 and go to Medicare Advantage, they're spending less than what they were paying on the active plan. And the other part here, and I think one of you guys mentioned it, or Mr. Art, you mentioned it, is the value, the richness of the plan is not changing.
But remember, comparing Medicare to the active plan, people have paid into that for 30 years. They've been paying for it for 30 years.
Right, no, I get it.
Whereas other people hadn't paid nothing. So it's not accurate what you just said.
No, right, yeah, well, you do have a subset of people up until a certain age that actually didn't, and that's a question we had just, is there a group that didn't pay into insurance up and, I'm talking about, not Medicaid, I'm not talking about Social Security. I'm talking about people that didn't pay into, that didn't pay any on our active plan, a $0. In other words, was it free for all employees at a certain point?
No.
So they always paid it, okay.
Again, like I said, I think we need to make a change, the least disruption as possible. The points Ms. Boudreau made about, the medicine, I can agree with that. So, I don't know if y'all want to come up with a plan, if it's beneficial to go back to Humana and say, hey, can you do this? And do we have the time? Or just maybe accept one of the ones that they've already put out there?
Yeah, looking at the plan designs, option B is at 8.78%. When you add in, which is H, you add in a $100 drug deductible, it goes down to 7.53. So if we combine it with option D, it's going to be somewhere between 7.53 and 8.78. So you start splitting hairs when you do that combination. So it's going to be somewhere in between that, safe to say. So.
Well, we're splitting hairs for us, but $100 to a retiree that's 78 years old with a fixed income,
No
$100
doubt.
is a lot more than zero.
Absolutely, absolutely.
Yeah, I think it,
So looking at just option B gives you, or option C gives you a significant amount of savings without addressing the prescription and letting that benefit stay the same.
But D does go up significant for the second class drug and the third class, and then the total percentage. It goes from $20 to $30, and then that third tier goes from $40 to $60, which if they get a prescription every month.
Oh,
Is
absolutely.
a
Right.
pretty significant increase.
You talking about D?
For not much change in the premium is kind of the point there.
That's what I was saying. And that's what I was saying from a cash, I mean, I'm thinking about somebody that's over 65 who's quite possibly on a fixed income. That, I don't see the benefit, this major savings for us. That's why I was looking at
So then
either
H.
B or C, and then looking at C and either D or C and wherever we're at right now.
Because H keeps the cap at 25% versus 33%.
Correct.
Well,
I don't know.
I know I've been here the whole time, but I missed
The board does have the option to only change medical. You don't have to change the pharmacy. So you can only
Pharmacy can
choose.
stay completely,
Yes, ma'am. So you can
Yes.
only choose options A, B, or C, and just that.
You can
don't
choose
have
C and
to-
not touch it,
You don't
right?
have to do a combo. So you don't have to change the pharmacy if the board's pleasure not to change the pharmacy. You
7
can
point.
just change medical.
And
just
again, it goes
B or
back
C.
to my point, like, C, you have a savings. And this prescription thing, you're looking at
yeah, not a significant savings.
less than 2%.
So then our real only decision we should make here today is B or C.
Yes,
That's fair.
yeah, I agree.
I mean,
I agree, because you
No?
don't want, when you look at your pharmacy, the point that Art made is correct. I mean, you're talking about
That's
that
not right.
33%. So really and truly, we need to look at just the medical option.
Yeah, I didn't even see the 33%.
C gives you the save. C, if you look at C 7.08% change. That's almost the savings you get with H.
Becky, you mentioned C first. Is that where you're at?
You know, as I said earlier, that I wasn't really thinking of C, I just wanted to have the conversation of C. I'm looking at the
Ms. Weber, can you
longevity,
please move your mic closer to you,
Oh,
please?
can't hear you.
looking at the longevity financially of the board, that's what I'm thinking of. And also considering our retirees and the amount of money they put into this, this program, and getting what they need. I want to be making sure we're honoring them, but in the same breath, making sure we're staying within the means financially. Because if we got to come back next year and look at it again, then who are we helping here? If we can make some changes here, some strong changes, then maybe we don't have to do anything within the next couple of years. So that's what I'm kind of thinking of.
Touch the prescription.
Yes.
Yeah.
And I think whatever we do, we need to be, what's that word y'all use? Transparent.
Yes.
And let them know that, we didn't make no changes to the pharmacy aspect, but because of the cost of insurance, we had to make some minute
Right.
adjustments to the other plan. And I think they would be, accept that, so.
I want to point out, I don't think anybody's mentioned it, but when you look at cost summary, right below it, Medicare retiree, and you have the premiums, this does reduce the premium for them as well. I mean, right? If they have to pay any portion.
A couple of
If they're
dollars.
over 20 years, it's, but.
It
I'm saying-
suppresses the renewal.
Right?
Right.
Right.
It's going up, but it just.
But like anybody that has to pay a portion based on policy, so.
So can anybody want to make a recommendation, or?
And I just want to clarify that the $100 copay for inpatient, outpatient will accrue towards the $500 out-of-pocket. Once the 500 is met, then it's 100% from there. Just to clarify, that's why the 500's there. If it's only the deductible applies, you would pay the 100 so the max is 500, just to clarify.
And C.
And no change to the pharmacy?
No change to pharmacy.
I agree.
Because that protects anybody getting pharmacy the way that it's always been. It does not change, even though that's the biggest cost. This
And
changes that.
please let our people know
Let
that,
them know.
a lot of considerations go into this, but because of the cost.
In order to protect pharmacy costs.
And we wanted to protect the pharmacy costs and the pharmacy program, so.
And what you just said.
And I truly believe, with being part of elderly parents and mother-in-law and myself and my husband, that it is the pharmaceutical side of it. It's the pharmacy side that you're seeing. It's not so much as being outpatient or co-pays, it's the amount of money you're paying for pharmaceutical drugs. So I do feel like if we can keep that and change our C, but I want to say again, like Mr. Oakland, we need to be very transparent with our employees to let them know what are we doing here, and that we took a lot of time and consideration to make sure that we are honoring them and protecting them and trying to do what's best, but in the same breath, protecting the district as well, because we don't want to come back next year and say, okay, we're going to have to raise it again. We're trying to avoid that.
Committee does have to do an actual recommendation for this to
Mr.
move
E has
forward.
some
Mr. Ellis, you have some
he's got
questions?
I have a couple of questions.
Okay.
How many,
Mr. Alexander, can you please move the mic towards you?
how many people are we talking about that's eligible for Medicare? Oh, 979.
At the present, we currently have approximately 967 members enrolled in the Medicare Advantage plan. Of those 967, there are approximately 210 spouses enrolled on the Medicare Advantage plan.
They're included in that 967?
Yes, sir.
Okay. So we-
967 total approximate members enrolled on the Medicare Advantage plan.
And how many people are enrolled on the other plan, the working people?
The group plan?
The group plan, I
It's
will,
approximately 1,960, somewhere around there.
Okay.
I
around
mean,
two-
at last glance, which it's
And,
approximate,
and
around
how,
3,800 members.
and how about the two different costs for the 967 and almost 2,000 people? What's the difference in the price?
So our next agenda item is to talk about the policies and the rates for the retirees, because the rates, potential rates, if the board chooses, will be dependent on the policy, and that's the next discussion.
Yeah, the board
How
cost.
much the board cost, is what he's saying?
The board cost is what's listed, so we pay if you were to go with option C, it's the $245.79 per member per month.
I can kind of, Mr. Alexander, so right now, the board pays, if you look at just the Humana, the first column, the board pays about 3 million for this premium. But for the general plan, the board pays about 38 million, okay? So you're talking, and you got to remember, the folks in this plan have been paying into this and not using it for their entire lifetime into Medicare. You've been paying this every time, the medical FICA, you pay, you just keep paying, so, but for the other plan, you pay for that on a per month basis, but not on a, if I'm making myself any clearer.
And to clarify,
I understand what you,
the Medicare Advantage, I think this year we're paying approximately 2,663,000. It would be 3,017,000 right there.
Oh, okay.
If we just said, hey, is that
Okay.
accurate?
okay.
Make sure.
So that's a lot cheaper than insuring regular people. Okay, and
We save quite a bit by moving and making that migration, because all those claims now are on Humana and CMS.
absolutely, because we could be paying $70 million to insure everybody. My next question is, when a retiree has both Medicare and Medicare Advantage, which one is primary?
Medicare is primary, Medicare Advantage is secondary.
Yeah, so, okay.
When a member that has Medicare Advantage, they go to the doctor, they present their Medicare Advantage card only. The Humana Medicare Advantage card.
Okay, so which one is primary? It seems like Medicare Advantage is primary, if that's the card you present. Am I correct?
They work together.
Yes.
It's combined. In other words,
But
this
you
is, the
have-
Medicare Advantage plan we have is the supplement to Medicare.
Right, so that's what my question is, so Medicare is primary? And so
And you're paying-
you're not
and-
really
and they're
gonna
paying
use
$200 a
this
month.
Medicare Advantage that much.
Yeah, so the Medicare Advantage picks up what Medicare Part A and B doesn't cover.
Doesn't cover,
Yes,
and that might not be too much,
that's correct.
that's all. questions I have. Thanks.
And just one quick point about the copay, I just want, that was in the details. The $100 and the $50 is a per occurrence. So it's not like the $50 deductible. Every time you have an outpatient or an inpatient, you'll pay the copay. But again, it accrues towards the $500 out of pocket. On C.
It's a copay, not a deductible.
So if you have a $500,000 surgery, you pay $50 if it's outpatient or $100 if it's inpatient.
Make a motion to accept C.
I'm in favor of C. Everybody in favor of C? Yes. Any objections? Okay.
Administration will prepare the item for,
And if I could just ask,
Be presented at committee for full board approval the following Wednesday.
Waiting.
full
I can't make
board
it
recommendation
right now.
to the Wednesday meeting, if I could just ask Ms. Gray or Ms. Burris just to kind of provide a summary of this conversation and where this committee landed to send to me so that I can include that as part of the weekly scoop, so that those board members that were not in attendance today will at least have the background summary for this meeting.
I would appreciate that.
Yes, sir.
Dr. Ortman.
Thank you, thank
You
you.
know, and off this too, I just want to mention, these plans also provide a dental and eye and ear benefit as well, which like our current employees pay for hearing, vision, so forth. And then, once they retire, they don't take it with them. They can't get on those plans. So this is a benefit, once you turn 65, that you regain by being part of this Medicare Advantage program.
And I recall, because I think I brought that up yesterday when we met, that we added it in January of '23, because I recall that, I think the first agenda item we had, first or second month that we had, and I just was blown away at how rich the plan was. But I'll certainly be prepared when I'm 65 to get insurance.
Next up is policy.
Okay, if we can move to B, which is the policy, and talk a little bit more design plans.
so we are having discussions about board policy 4.06.13 because there were discussions about what the premiums are for Medicare Advantage and whether or not the dependents are paying a premium for Medicare Advantage. Because the premiums are set by the policy, the board is currently unable to vote on premiums without having a policy change. So if you take a look at the policy, you'll be able to see that we made some changes to this policy to be able to provide the board the opportunity, if they so choose, to assess some rates to the retirees and the spouses only for Medicare Advantage. We do plan in the future to come back to fix a couple of other things in this policy, but for the essence of time, we were unable to do a complete overhaul to have it done for this meeting, so we're only focusing on the portions of the Medicare Advantage. So on the first page of the policy, you're gonna see that we scratched out the comparisons with the 15 to 19 to the 10 to 14. Later on in the policy, you'll see we made some changes where that no longer matters because we're just sticking to the percent rate structure and we don't have to make those comparisons to the active plan. The current policy, the way it's written, makes comparisons to the base plan that the retirees pay. But as you just previously had those discussions, it's a completely different plan. The price is completely different. What the board contributes is completely different. So we no longer felt that that was appropriate to have those comparisons in the policy, so that's where those scratch outs came on the first page. When you get to the second page of the policy, you'll see that's where, again, we crossed out the exceeds 2/3 of the premium equivalent for the active plan, so that was being compared to the base option on our active plan. As your previous discussions, what the board pays for the Medicare Advantage versus what they pay for the active plan are completely different, so we're taking that out. We're recommending that the board remove that from the policy. As you go further down the page on section 2, you'll see where it starts to discuss the spouse's coverage on a Medicare Advantage. We're making a recommendation that the percentages increase slightly for the spouses so that there can be some contributions. And just so you know, there's also another attachment that simulates these rates that we'll get to. I just wanted to talk through the policy, and then you'll see how the policy actually works in the simulation. So Louisiana Division of Administration says that the board is required to cover spouses on insurance, but it does not dictate how much you have to pay. So as you start to look at this policy, and a lot of people do comparisons and they look at Office of Group Benefits, I also showed Mr. Gregson with spouses pay with OGB on Medicare Advantage, and it's a lot more. So we made the recommendation to make the change of if it's a spouse whose retiree was only here between 0 to 1 years, 100, 2 to 9, 75%, 10 to 14, 50%, and then 15 or more, they'll pay 25% of the Medicare Advantage premium. So for example, if the board, since the board is making a recommendation to the full board of option C, if the premium is $245.79, depending on what the vesting schedule is, the spouses will pay the percentage of that premium. So each spouse and each retiree each have a premium. So depending on if they're both on the plan or if they're one or one off, these percentages will dictate how much they pay for the Medicare Advantage. And this is just a recommendation. So if the board had other thoughts on percentages for the spouses, we can make those changes as well. So if you now go to the rate simulation, you'll see that Ms. Burris prepared this simulation based upon the policy for both the spouses and the retiree. It has the percentages that the retirees would pay. So based upon this policy under option C, you'll see what the 0 to 1 options are, the 2 to 9, 10 to 14, 15 to 19, and 20 or more. We have more retirees that are in the 10 to 14, and then you jump to the 20 or more. So you'll see for the retiree only, 10 to 14, they'd pay $56.53. If it's the retiree and their spouse, $179.43. Spouse only, including surviving spouses, is $122.90. And then if you jump to the 20 or more, which we do have a great deal of retirees in that category, the retiree would not pay. The retiree and spouse would be $61.45, and then the spouse only is $61.45. What questions do you have, or what can we
And that's
explain more about that?
And our previous CFR, remember he had the formula and we couldn't figure it out, but that previous 6145 was zero, if I'm not mistaken, because of the way the formula took. So, so that would be a little increase for the spouse of the employee.
Historical perspective, so a few years ago, we had a credit, and the board decided to pass the credit on to our retirees and their spouses on the Medicare Advantage plan. Once the credit ended, the board voted to continue to not assess any costs towards the spouses and the retirees. We no longer have that credit, so we wanted to provide the board an opportunity to potentially collect some of the cost share of the premium from retirees and spouses. So that's what this policy change recommendation comes from. And Ms. Burris made this based upon all the options to consider. Since the board's leaning towards the option C, that's what the simulation of the rate change would look like.
And just a point of clarification, because of what was discussed in the last few years, that kind of covered, the board itself has been covering 100% of that cost, as Mr. Oakland said. So because of the way that calculation, that formula was built, the comparison of the base, comparing it to the base, it had to exceed a certain amount of the base premium in order to even begin to charge back that level. The modifications that we're proposing would take that comparison away, which means we would be able to begin charging a minimal, or at least a reasonable amount of that premium back to the retiree.
So what I'm understanding, and I'm gonna use Mr. Oakland and his wife. So they will, if we
Excuse me,
do.
I'm not Medicare eligible yet.
Oh, okay. Well, let's pretend he is, and his wife, let's pretend. If that's the case, then option C, retiree and spouse, they would pay $61.45, correct? Am I correct? If we decide to vote on this at the board meeting, in everyone's agreement, it's a possibility that would happen.
Yes, ma'am,
Correct.
plus possibilities. So if they were both on the plan, they would pay a total premium to St. Charles Parish School Board, $61.45.
And I thought Mr. Oakland was 65 because he's so wise. So wise.
And as Ms. Gray mentioned, the majority of our retirees on the Medicare Advantage plan have 20 or more years of service. There are very few, if any, in the 0 to 1 year category and the 2 to 9 year category. And also keep in mind, these rates are just for the Medicare Advantage plan only. As we stated before, they do also pay their Part B premium to Social Security. So this is in addition to that Part B premium.
So one thing we figured out, based on questions I had from Ms. Gray and Ms. Burris, were on page 2 having to do with, if you take the first section having to do with the first set of 1 through 5 bullets, and then this, where it says 67, 33, 23, and 10, there was something mentioned a few years ago when this policy was edited, that these were the minimums, but and that's, if you notice, Ms. Gray just mentioned Division of Administration, and she didn't mention OGB, because the Division of Administration, and I forget the statute, it's 42, something or other, anyway. The Division of Administration, if I misspeak, chime in, sets those rates, and it was pulled I don't even know where it's pulled from, something from OGB, but it was just in that. So these 67, 33, 23, 10, there are some, quote unquote, there are some minimums, but these are not necessarily the minimums. I forget the percentages, but, so just for clarity, that can be adjusted to a different amount up to whatever is the division. Do you remember what they were? I forgot. Sorry, I didn't mean to put you on the spot. I might have it written down. But anyway, those percentages don't necessarily have to be, because my question really was on, not necessarily that I want to adjust the 15 to 19. My question was like, hey, is it actually the 0 to 1 or the 2 to 9? You know, do we have to pay 33% for somebody that spent 1 year, you know, with us? There's a minimum, but I don't know that, I think it might be less than the 33%. So, and I think that's where they recommend the adjustments for the spouse. That's kind of where I think it came from as well.
So I think to Mr. Gregson's point, if the board so chose to modify that percentage, well, I appreciate Ms. Burris and Ms. Grace and Mr. Neighbors who worked on this particular policy, because I do think it's fair. But to your point, how much do we want to contribute to somebody that may have only spent 0 to 5 years in our school system? So I do think that's a valid point worth discussing, whereas the others I do feel are pretty fair from that standpoint.
yeah, thank you. I want to clarify, I am not suggesting to change our 20 plus. For anybody, this is recorded, so I don't know. I don't need the retirees knocking on my door tomorrow or this afternoon.
So this is just me. But would
There
it
are
be
minimums.
appropriate for retirees with 0 to 5 years experience? The district rate would be 80, 90, 100% of the Medicare Advantage premium?
There is a minimum that we
There's a
have to
minimum?
pay.
Okay.
I just don't,
Yeah,
I
you
forgot
don't know
what it
what it
was.
And while they're looking that up, Ms. Pierce, this is just a side question, and I know it's unique, but there are employees that are married, me, one, but I'm saying that just because I know there are always a handful, right? There are about 30 or 40 that are spouses together. I didn't necessarily see that differentiated. So let's say you have 2 employees that are married, they're retired. Where do they fall under employee and spouse piece? Let's say if one hit the 20, one didn't, if they both hit it, it would not be. So can you kind of just share that? Because we have probably about 30 of those.
Yes, sir. Dr. Ortland, thank you for your question. So there are instances, and we where the spouse becomes Medicare eligible before the retiree. So the spouse would go on Medicare Advantage, the retiree would remain on the UMR plan. If you look on page 3 of the policy, the language states that the rate which the retiree with a spouse on Medicare Advantage, they will pay the spouse rate, and the retiree rate would be the retiree rate only for the UMR plan. Thank you for that question.
I found it, but I don't like to do policy at the table to.
Yeah, we can do it. We can
to
talk
say
about it
on the
later.
Spot, if I could provide a follow-up. for
Yeah,
it.
yeah, no, let's please, yeah, definitely. Get clarification, yeah.
I'm looking at the, number 2, for retirees with 2 to 9 full years, it's set at, 33%. But from somebody with 1 year, I don't know if you know what I'm looking at. Wait, I'm sorry. Under the rates for retirees for the spouse. For retirees with 0 to 1 years employment with the district, the rate will be $100. 100%. For retirees with 2 to 9, the rate will be 75. That's a big deduction or cut from 100. I think it should be more graduated than to put 75% for everybody from 2 all the way to 9. You might want to do that on a year 1, 2, 3, 4. Every year, it would be a reduction. But like if you go from a 25% reduction from 1 year to 2 year, and you stay at that rate for 9 years, maybe you can start at 2 years and it would be 90%, 3 years, 85, 4 years, 80, something like that.
I think, and I think that
Are we talking spousal or are we talking employed?
The spouse.
I think when Ms. Gray does the follow-up, I won't speak for her, you'll see that there are some minimums with some years, range, yeah, there's a range and there's some minimums which will impact that. It's from the division administration. When she sends a follow-up, I think we'll see. I don't recall exactly what it was.
And I apologize, we were trying to find the policy. Ms. Kelsey Hegel has some very strong security that my iPad couldn't get to it. You can read it.
Okay. So per the revised statute that Mr. Gregson mentioned, the bullets are as follows: 19% for those with less than 10 years of participation, 38% for those with more than 10 but less than 15, 56% for 15 but less than 20, 75% for 20 or more. That's the minimum in terms of the state contribution. So the employee would pay the flip of that. So the employee would be the 81, the employee would be the 62, the employee would be the 44. It would work to the contrary of what I proposed. So this is the amount that the government would have to pay for that employee's behalf. So the employee portion would be the inverse.
Can y'all
of that
provide
number.
us with that so I can look at that?
Yes, sir.
Yes, sir, we can provide that. So we'll do a follow-up and provide this information, and those percentages are only for the retirees. So for the spouses, the law just says that we have to cover them. It does not dictate how we cover them.
Wait, I think you said that the opposite way. This rate is for the spouse of the retiree, not the retiree.
the law that Mr. Neighbors just read, that's about the retiree. It does not apply to the spouses.
Okay.
The law just says we have to cover them. It does not dictate what the percentage that we have to contribute.
Yeah, that's what it was.
Okay.
We get to determine that.
We get to determine that.
Yes, sir. So this recommendation was taking what they had here, but increasing it just a little bit, but we still have to have categories.
So, Mr. Alexander, if you don't, can I kind of summarize? I think I understand where you're going. Basically, for us to have a chart for the spouse for that portion of the policy that outlines more incremental steps.
Yes.
So in other words, if from 0 to 2, it may be 100%, but whatever that is, after that, you would like it kind of like in a chart.
Yeah.
3, 4, 5, and gradually decrease where you're still hitting similar marks, but you want to kind of mapped out. That way, it's not just encompassing this wide range of years.
Yes.
And then to Mr. Gregson's request relative to possibly determining a higher percentage for retirees by meeting the minimum standard referenced by whatever y'all are referencing over there.
42,851.
Okay, 4283. That risk management and insurance, administration brings back to the board maybe a range for those that have spent less time in St. Charles Parish to maybe have a higher rate of pay, but not necessarily the incremental piece, because then obviously we have to get into a lot more detail.
Yeah, and now I'm just going to add one thing on, and I should have asked this yesterday when we had a conversation. If this is not too difficult to get, and, it's not an act of Congress, do we know that breakdown of 967 in each of these, your beautiful table here?
We can certainly bring that information back to you, so.
Maybe send, if it,
To understand how many retirees that are in the 0 to 1 category, how many 2 to 9.
I don't want to
so
split
forth.
hairs if you only got 2 people in this, I mean.
Absolutely.
Yeah.
We can get those numbers and bring it.
Well, because I think when we were talking about this last time, we have talked about
If it's
maybe
available.
this specifically, the retiree, there's not going to be a significant amount of people who are retiring with only 1 year here. And then it was someone in the actual room who had just come here, and it would apply to him of the, just 2 or 3 years because he came in and took an executive role here. So you could fall into that category, but it's rare. Because this is mostly encompassing people who have been in St. Charles Parish for 20 years.
So, Ms. Burris, can we get that? Because again, we're going to bring this to the full board on Monday, and the same discussion is going to go over and over again. So just, if we can make a recommendation as the committee, bring it to the full board on Monday for committee, then, like I said, more discussion will take place. But if you guys will be able to do this for
Then we'll have
Monday.
more information for that discussion.
And just for clarity purposes about making the progression, I just also want to put in front of you for the retirees, if we do the progression just for the spouses, the charts will get very confusing for the retirees. So we will prepare based upon your request, but I just want to make it clear that I think it really will confuse the retirees to do a progression just for the spouses, because the law requires only 4 categories for the retirees. So trying to make it a clear picture for the retirees to understand may be a little difficult. So just want to put that out there before we prepare it and bring it to the board.
And I guess my question on the number of people, is that something that y'all have, or Humana has? Or do we know that? Is that a you guys, how many in?
That's something that we can gather that data on and bring it back to you guys on
I didn't know.
Monday.
Yeah.
Yes,
Yeah, like
USI does
who
not,
falls in this each?
they don't carry the
Humana only knows the
retiree
number that
insurance.
are participating in the.
I'm only looking these as groups, not 1 year, 2 year, you know what I mean? Not in, based on the,
Are those 4 categories made by the government, whoever? Or, the 0 to 1, 2 to 9, 10 to 14, are those standard 4 categories?
So the way that we have it now, it's not in those years, but there is 4 categories that the government says we have to have.
And it don't have to be this, it could be 0 to 3, 4 to 9, something like that.
Yes, sir. So it is different. So the title, sorry, my iPad
It's,
will not let me pull it up. It's less than 10 years, 10 to 15, 15 to 20, and then 20 or more is what the Division of Administration has the categories.
I would like to see us use those 4 then.
We can bring that back, sir.
We got, it's, and for the record, it's Louisiana Revised Statute 42:851.
Ms. Grace, say those categories again, the age.
Yes, sir. So less than 10 years, 10 years to less than 15 years,
Okay.
15 years but less than 20, and then 20 or more.
20 or more.
And while there's a quick pause, I'm notified the chair, I need to go to Baton Rouge for the MFP legislative meeting. So Ms. Babin is here. She's going to continue taking notes on my behalf. So I just wanted to make that announcement. Ms. Babin.
So the reason you're wanting the table and the reason that you're wanting this is so if there's, how many people does 0 to 1 even affect that we have its own category? Is that, am I understanding that?
Yeah, I
Mr.
just, I
Ellis?
mean,
Also,
Ma-
but Mr. Ellis is who I'm
Oh, sorry. I
directing
thought you were
this
looking at me.
towards.
What's that now?
Well, you were between me and him, so.
I didn't hear. I thought you were.
The reason behind that, well, it's kind of both of you together. You wanted the table of how many people it is, because if there's one person, then why does it matter that we even offer 0 to 1? Like, just if it's under 10,
right.
catch them all. But if there's 50 people that have only been here for 1 year, why are we paying significantly more for their retirement costs, right?
So to make sure that administration understands, we'll
They're
prepare the
not
numbers.
just going to come here in their last year because now we're going to pay all of their retirement way higher than another
That's an
district.
excellent point, Ms. Boudreau.
We got it.
Yeah. So to make sure I understand, we'll prepare the numbers in both formats, in this format and in the format that's prescribed by Division of
Yes, because
Administration.
there
Yes,
is
ma'am.
a value to that 0 to 1.
Yes,
that we
ma'am.
cannot forget about.
Yes,
Okay.
ma'am, we will
Thank
prepare
you.
both.
Okay, y'all comfortable?
Yes, sir.
All right, let's move on.
Risk Management and Insurance Committee, it's just a fun committee with lots of great things.
The final topic on the agenda is to discuss the impacts of changing the insurance renewal date from 5/1 to 7/1. There is a document located in Assembly titled Impacts of Changing the Insurance Renewal Date. So just to give you a brief summary, so we have been looking into changing the renewal date from 5/1 to 7/1 to better align with our fiscal year. The Risk Management and Benefits Department has had multiple meetings and conversations with our broker, USI, USI's legal counsel, our TPA UMR, our pharmacy vendor, OptumRx, to evaluate the operational, financial, and compliance impacts of changing that insurance renewal date from 5/1 to 7/1. While it is possible, there are a lot of mountains to move and a lot of mountains to climb. So just to give a brief summary of what we've learned so far, starting with stop loss. So our stop loss date originally stated we couldn't change it until 2028. However, USI is continuing those conversations with Tokyo Marine, and it is possible to be able to move it in 2027. With regards to our TPA UMR, UMR stated that they can extend the current administrative services agreement for 2 months. However, it would require underwriting approval, and they would need to know by the October 2026 timeframe whether or not we're going to extend it in 2027. Our OptumRx, our pharmacy vendor, they have an integrated model with UMR, so they would follow suit with UMR. However, they would need to obtain pricing approval. Then budget considerations. So decisions would need to be made. We would have to have further discussions with our CFO and USI's actuary to decide how we're going to budget for the additional 2 months, or if we're going to do a 14-month budget cycle to capture May 1 through June 30th. And then one thing we recently learned with regards to the compliance considerations, IRS regulations requires employers to provide employees with an opportunity to make benefit elections at least once every 12 months. So moving the renewal date from 5/1 to 7/1 would require us to have 2 open enrollments. As you know, administratively, there's a lot that does go into conducting an open enrollment. So having 2 open enrollments would require extensive planning with regards to communication to ensure understanding. And we would need to have additional conversations with our payroll department, our ID department, to assess the impact on file feed imports, system configurations, testing, and payroll processing timelines. So in summary, it is possible to move from a 5/1 to 7/1. It is our recommendation, however, to include this initiative in our long-range strategic action plan so that it would allow us sufficient time for comprehensive planning, stakeholder engagement, budgeting, and vendor coordination, and this approach would ensure a well-managed transition to minimizing administrative and operational risks.
So I know there's a lot of work that goes into, would this benefit you guys? Are you looking to do this? If it is, I recommend we go with your recommendation and move forward.
This would absolutely
Thank
benefit
you.
us budgeting wise, yes.
Thank you.
Is that, and just for clarity, are we looking to do this in 27 or put it in long range and do it down the road?
Put it in the long range to complete it by the end of our long range plan, 2028, 29.
Also, not to do it in 27 or wait till 28, 29?
Wait till 28, 29.
Okay.
But it's
And
because
then-
there's a lot of things that we need to
Yeah,
kick off.
I mean, look, whatever, if it makes it easier on operations, I'm in agreement with Art. Y'all do it. I guess my only question would be, not the 2 open enrollments, but the open enrollment in the future being June and a lot of our staff off. But does open enrollment start before the end of the year, like, so they can do it in
Currently,
May?
it starts March through April for the May 1 renewal.
In this case, it would be May through June?
Yes,
fair?
and that's part of the additional planning and meetings we would have to have in order to conduct the 2 open enrollments. So,
Because I think central office, and I don't know about you guys, are closed on Fridays and.
right, absolutely. And
That's all.
We are a school district, and school district operates, with a July 1st renewal. It makes more sense because of your new employees who come in during the summer than when they do come on now, they got to get on the existing, portion of the plan. This would make more sense with the way the school year works and so forth. So my opinion is whatever you guys want, let's get it.
Yeah.
Thank
Yeah.
you.
Do I
That
have a
is all
motion?
of the lovely
Like move to
materials that
adjourn
we have for
then?
you
Are we
guys
done?
today.
All right, well, I move to adjourn.
I second.
Everybody
All right,
seconds.
Thank you.